In this section, we're going to look at some of the trends in data usage that are starting to build momentum, but may still be below the radar of many investors. When we look through the use of data, we can usually see some obvious trends. When the S&P 500 recently had its 5% single-day decline, demand for S&P 500, Nasdaq 100 and Dow Jones Industrials data shot up, as did searches for news about the oil market when crude oil prices had a significant drop at the same time. I caught up with Refinitiv's CEO David Craig to ask if there are any specific trends that are emerging. For instance, which areas are starting to see an increase in momentum, and can we glean any insights from this data on data? David, first, could you maybe outline what data on data actually is and how we can use it?
We're obviously distributing billions of data points around the world every single day. And one of the really interesting insights that we're getting at the moment is looking on an anonymized and aggregated basis. Well, what are our clients retrieving? What data sets are they actually looking at? And what are some of those trends that we can spot literally on an hourly basis of how clients are changing the patterns of the data that they're examining?
And are there any standout trends that are currently building momentum, but perhaps have gone unnoticed for now?
Well, there's some really interesting trends that we're picking up, and some of them are things that you would expect, and some of those things actually you wouldn't necessarily expect. I mean, obviously, people are reading a lot around the news of the coronavirus and disease and pandemics. They're looking at those equity sectors that would be potentially impacted the highest, be they hotels or leisure or airlines, but also the sectors that might not have as much impact. I think one of the really interesting insights that we're gathering, which is in some sense surprising, is the amount of people that are increasing their retrievals on sustainable finance data and ESG data, which is up about 90% in some sectors. I think a couple of dynamics are happening here. I think it's been well reported, including by us, that many of the companies and the funds that had higher ESG scores have performed better through the crisis than the ones with lower scores, even if you take into account the fall in oil price. But I think a second thing that is happening is that investors go back into the market and asset managers are rebalancing portfolios. They're looking very closely at the ESG scores, particularly around carbon and carbon equivalent emissions, and trying to make sure they rebalance away from those sectors that have created challenges in the past. You're seeing both an acknowledgement of higher performance and higher resilience by the investors, but also a desire to move away from some of those more legacy assets that have caused challenges with higher carbon emissions. The sell side is recognizing that they're catching up with the buy side now, and they're looking at the data to try and create products and capabilities that can support the buy side's investment desire on the sustainable finance areas and ESG scores. I think also other sectors are just a little bit slower, I think, to pick up on this trend. And there's talk in the media, for example, about sustainability being on the back burner through the crisis recovery, whereas in fact, a lot of the government actions and things that we're seeing are actually putting a sustainable recovery more at the forefront of the investment and the type of fiscal actions that are being taken for the recovery. So I think you're seeing different sectors of the market basically pick up on this at a different pace.
So that does seem slightly surprising that this has been missed, considering that it's the investment community itself, so the wealth managers, portfolio managers and brokers who have been leading the charge. Why do you think that is?
Well, the highest consumption and the highest uplift within the investor community and the wealth area, the brokers, the investment managers, the lower actually was in media, and which is quite curious because often the media is sort of ahead of the trend. It looks like maybe the media is behind of seeing this trend and what is happening. If data is the new energy, as I like to think about it, just understanding energy consumption and the patterns of consumption is another source of insight. Understanding how that energy is being used, that data is being used, where it's being used, what types of data people are looking at, is bringing some real insight to the market about where the money is flowing or where the risk is or where the activity and the appetite to investors.
The data is showing a significant increase in demand for ESG data from certain parts of the investment community, whilst the media have gone cold on this trend, probably because there are so many other investment themes that need covering at the moment. And it doesn't really matter whether you agree or disagree with the theme. In investing, it's always worth following the money, or at least it's worth knowing where it's heading, as this can help us make investment decisions. And Goldman Sachs recently pointed out that 31% of passive flows year to date have been into the ESG theme. Over coming weeks, we'll continue to watch for the biggest shifts in the data usage across all themes, particularly changes in momentum, to see if we can pick up on some of the trends before they reach the mainstream.